Okay, thanks for joining me. Today I'm going to do the AQA Accounting Unit 1 June 2014 paper. Specifically question 3 and question 4. The June 2014 paper is the most recent paper and it's just been made available on the AQA website, so make sure you have a look at it. It's a tricky paper. I'm glad I didn't have to do it in my first year. It's sort of, I'd say, theoretical. It makes sure you understand the T account. It's not simply calculate the amount of this accrual, edit your expenses, edit your liabilities. It's underlying stuff. It wants to know all the T account stuff, why that all works, why does that make your trial balance balance, why does that make the balance sheet balance. It wants to know all that, and it wants you to correct errors in the T accounts as well. So let's get straight into it. So I've been given a list of values in a trial balance, and what they want me to do is correct 2 errors here and then put them into the journal. So what I find is the best way to represent this is to just draw some T accounts and do it that way. So error 1 is a payment of £4,000 for rent payable has been posted to general expenses. So the titles of my 2 accounts are going to be rent payable and general expenses. So gen exp. So a payment for £4,000 for rent payable. So they're both expenses have been posted to general expenses. So if you pay for an expense, it goes up on the debit because expenses go up on the debit. So what we've accidentally done is made a payment for general expenses. So that is the original error. So we need to correct that straight away, that £4,000. So we just credit it. So that's one correction. So basically what we've done there is we've made a mistake and we've just cancelled it out. We've increased one side to equal the other, so it won't affect the trial balance in any way. So rent payable. Well, if we made the mistake there of putting expenses on the debit, we just need to put it on the debit of rent payable because we've paid the expense. So £4,000, and that is a correction. So now what they want me to do is just to put what I've done into the journal account in a sense. Say what I've done in a sense. So the 2 accounts that I changed are rent payable and general expenses. So what did I do? Well, I debited £4,000 in my rent payable and I credited £4,000 in my general expenses. And that's that. And we just got to do the second error now. So a payment of £2,000 for new plant and machinery has been posted to purchases. So we've got P&M, plant and machinery, and purchases. So this is actually very similar to the first error. It's very similar. So a payment of £2,000 for plant and machinery has been posted to purchases. Sorry. So what are purchases? They're an expense, so they're going to go up on the debit, and we say we made a payment for them. So what we say we've done is that's the mistake we made, the original mistake. Need to correct that, so it's just the same as what we did with the general expenses in a sense. We're just going to credit the other side to make it equal as correction. So what did we actually do? Well, we made a payment for an asset, a non-current asset, plant and machinery. So what we've done there basically is we've increased our assets, and assets go up on the debit. So we're going to have to debit £2,000 to increase our assets. So that's a correction. So it's just the same thing again basically. We're just going to enter that into our sort of correction sheet, I don't know what it's called. So plant and machinery, specifically the at cost account in a sense, and purchases. So it's just lifting the information from the T accounts into the sort of answer bit they've given us. So what did I do to plant and machinery? Well, I debited £2,000 and I credited £2,000 to purchases. That's that. That's part A done. I'm going to go quick with these errors. That's commission, that's principal. Just Google them, it's really easy. Just make sure you understand what they are. I don't want to go through them that long because it'll just be a very long video. I don't want that. So what basically they've given me now is they've given me a trial balance and they want me to put what side each of the brought downs will be on. So this is where you really need to understand your basic T account: assets and expenses on the debit, incomes, liabilities, and capital on the credit. You really need to understand that. So it also, what it really says that's important: prepare trial balance at the 30th of April 2014 after taking account of the two errors. And then the bank overdraft they've left blank, saying we hadn't given us a bank figure, have they? They've given us a question mark. So that's going to be the balancing figure in a sense. So basically you can't tell if you got it right or wrong, because it's always going to balance. You're going to get two different figures here, and the bank overdraft will fix that. So it can be a bit tricky in a sense, because you won't know if you've got it right or wrong unless you're absolutely sure you've got your debits and credits right. So first of all, capital. So capital, I just said before, goes up on the credit, so that's just 50,200 there. Carriage inwards. Well, carriage inwards. What do we do with carriage inwards in the income statement? Well, we add it to our cost of sales, and if we're adding it to our cost of sales, we're increasing it, which means we're taking more away from our revenue. So basically, it's increasing our expenses in a sense. So that's going to be a debit, because we increase expenses on the debit. Carriage out, well, we add that to expenses, so that's a debit as well. Discount allowed, well, we're decreasing the amount of revenue we're getting by giving people discounts. So it's decreasing our income. Income goes on the credit, so it's going to be the opposite. It's going to be the debit. So that's just going to be 3,150. Discount received, well, where does this discount received go in our income statement? Well, it's added to gross profit. And what do we add to gross profit? We add other incomes. So that sort of gives it away, and incomes go on the credit. So that's that. So what you can sort of do is you can draw links in the income statement. Well, if revenue goes up on the credit, well, all expenses go up on the debit. You can sort of work out what side they go up and down on just by that. Or you can just learn the assets and expenses on one side, incomes, liabilities, capital on one side. Either way, in a sense. So drawings. So this is an example of the linking. Well, if capital goes up on the credit, drawings in a sense is the opposite. Capital is putting money into a business, drawings is taking money out of the business. So if capital goes up on the credit, drawings must go up on the debit, because it counteracts the capital. So what's important now is I've said it's after taking into account the figures we had earlier, the errors. So general expenses was 28,150, and what did we do? Well, we've credited 4,000 in the general expenses account, which is decreasing an expense because they actually go up on the debit. So putting something on the credit side of it as expenses T account will decrease the amount of the expense. So 24,150. Okay, inventory at the 1st of May 2013. Well, that's obviously, oh, I'm not even put it in yet. General expenses, that's an expense, so that's debit. Inventory, that's an asset, so that's debit. Plant and machinery, well, we had 14,300 originally. Where is that? There. But then we added 2,000 because we bought some more in error 2, so that's just 16,300. Once again, it's an expense. It's an asset. 16,300. Assets go on the debit. The provision for depreciation, well, that's 4,800. So if the cost goes up on the debit, then the cost goes down on the credit. Depreciation brings the value of your asset down, so that must go on the credit. So 4,800. Yeah. Purchases, they were 8,400, but error 2 said, what did we do in error 2? Well, we decreased them, didn't we? Because we credited 2,000. So we're going to take away 2,000. So that's going to give us 6,000. Oh no, sorry, it's 84,000, isn't it? So that's going to give us 82,000. Sorry about that. 82,000 on the debit because it's an expense. Okay, where are we now? Rent payable, that's an expense, but we did adjust that. It was 44,000. But then we added 4,000 on in our adjustment for the error, so that's 48,000. Rent payable, it's an expense. Rent receivable, where are we? 2,200. Well, rent receivable, that's an income, isn't it? So 2,200. Returns inwards. Okay, so returns inwards in the income statement is taken away from revenue, so it decreases revenue. Revenue's on the credit, we're doing the opposite, we're decreasing the revenue, so we're going to bring it down, and incomes go down on the debit, which is what a return does, a return in specifically, so that's 620. So returns outwards is taken away from cost of sales, so it's going to decrease our expenses, we're decreasing the cost of sales, so that's just a credit of 480. Revenue, that's easy, that's a credit. Trade payables, that's a liability, so 21,480. Receivables, that's an asset, so that's 28,200. So this side comes up, debit comes up bigger, 27274. It's like Blue Peter, this, just like put the answers in. But this figure did come out before we put the bank overdraft in at 27. That's horrendous handwriting. That's unacceptable. 272,100. Okay. So the two figures need to be the same. So this figure debit, the total debits minus the total credits gives us 640. So this needs to be 640. Let's run my pen. 640. So now we have the trial balance. Perfect. They equal each other. So that's question 3. The answer is 272,740. So now on to part 4. So it's an income statement and a balance sheet, and we're given only 3 pieces of additional information. So this is question 4. So working 1. Also, they've jumbled they've given you the income statement, but a lot of the things are in the wrong place. Drawings is not an expense. You don't take returns out from revenue. Inventories are the wrong way around, as you can see. You're taking away opening when you should actually be adding it. Discount allowed, we said earlier, is an expense, so it should be here. So let's just get into it and see what we can do. So equipment depreciation for the year ended 31st of March 2014, so that's the last financial year. What we're doing now had been entered in the books of account and amounting to 1890. So depreciation for the year, so this is what will be going in our income statement, equals 1890, and the total provision equals 9210. Where have I got the 9210? Well, it's just simply in the income statement, the incorrect income statement. Equipment provision for depreciation at the end of the financial year is 9210. So that's what will be taken away from our cost to give us our net book value. So W2. Inventory of £500 has been omitted from the stock take, so we need to increase our inventory at the end of the financial year. So which of these inventories is the end of the financial year? Well, it's obviously this one because it's the same date as the top of the income statement. So closing inventory is going to change. So that's going to be 45,100, and we omitted £500 worth, so we need to increase that to 45,600. And the final one is a prepayment of 2,400 at the 31st to the end of the year. For rent and rates have been incorrectly treated as an accrual when preparing the income statement. The prepayment has been treated as an accrual in the books of account. So what's happened here? So basically what they've done is they've turned the prepayment into an accrual by accident. So 32,600. And what we're going to do here is we're going to minus 4,800. Let me explain why that is. So where's 4,800 comes from? Well, it comes from 2 times 2,400. So the expense was originally at this. Let's say the expense was originally at this point here, and when you have a prepayment, it should decrease that expense, so it should come down to here. But what we did was we increased it up to here by accident, by 2,400. So we've increased it by an amount. We've increased it by 2,400 and we should decrease it by 2,400. So I need to go from the accrual up here to the original expense and then back down to the value it should be, which is the amount of the expense minus the prepayment. And that's what that is in a sense. So with that in mind, I can now bring out the income statement. So we just have to basically put all our figures in and get down to our net profit and then put that in the balance sheet. So revenue was 315,200. Right, so what do we take away from revenue? I mentioned it earlier in the video, it's returns in. Where are our returns in? They are here, 9, 10. And that gives me a figure of 314,290. Okay, I left the gap here just so we can go through it together and work out what goes into our cost of sales. So there's three things going between our inventories. One, obviously, is purchases. We take away returns in from revenue, and we're going to take away returns out from our cost of sales. And another one is carriage in. So that's going to be added, that's going to be added, carriage in is added, and that's subtracted. So opening inventory is 47900, purchases are 217260, returns out are 1800, carriage in is 860, and our new closing in figure, which I calculated earlier, 45,600. We've taken away from our cost of sales, giving us a total cost of sales figure of 218,620. So the revenue, take away the cost of sales, gives me a gross profit of 95,670. Okay, there's now 7 expenses to go through, so I'm just going to go through them all as quick as I can because I want to get this video quite short. So carriage out, God, that's horrendous. Rent and rates, that was adjusted in workings free, so I'll just put in brackets workings free. Wages and salaries, I'm just going to put depreciation, that was working 1. General expenses, no, there's only 6 expenses, sorry. And discount allowed. So carriage out was 1490. I'm just drawing all the figures from the given income statement. That's all I'm doing really. Working free 27,800. I said I had for rent and rates, so 27,800. Wage and salaries, I'm just going to take that out of the income statement, 18,920. Working 1 told me that the depreciation for this year was 1890. General expenses were 6940, and discount allowed was 860, bringing me a total expenses of 57,900. So now just take that away from my gross profit to give us our net profit of 37770, and that's that. So that's the income statement done. Now we need to move on to our balance sheet. However, we're given a little bit of additional information here, which we need to work out first. So basically, I was reading Student Room, and a lot of people didn't like the format and the layout that they gave people the information. Basically, the first additional information, which was given with the income statement, that's all you need for the income statement. You're going to need a little bit of that for the balance sheet, but you don't need any of that for the income statement, but you do need it for the balance sheet. So, working 1 for my balance sheet is simply no adjustment has been made to any of these balances in respect of errors discovered in the income statement. So basically all we need to do is just consider the information that was given to us above that additional information. So I need to make sure that I consider this. I need to take that all into account. Okay, so W2. 1/2 of the bank loan is repayable in the year ending 31st of March 2015. So that's within the next year. So it's within a year of us making this balance sheet. The remainder is due after that date. So we're going to have a CL and an NCL. So that's a current liability and non-current liability. So we're going to have a current liability bank loan of 3,000. So I've just split £6,000. Where is it? £6,000 in 2. We have a non-current liability bank loan, which is going to be paid after 12 months have gone by at the same value. Okay, and working free, Jenny withdrew £4,500 from her business bank account, so drawings, as part of her drawings on the 31st of March 2014. This is yet to be entered into the books of accounts. So our bank figure is obviously going to change because we've reduced our the amount of money we have in our bank. So where is our cash in bank? 1,390 minus the amount of the drawings, 4,500, and that's actually going to turn it into an overdraft. So we have to make sure we know that is a current liability and not accidentally put it in our assets. It's actually the opposite now. So with this information and some of the information given in the income statement, we're going to now make our balance sheet. So how are we going to... Okay, well, what we can start off with is our plant and machinery, which is simply, let's put the title in first, so plant and machinery, which is simply 14,300 minus 9,210. Okay, so where have I got this from? Well, oh, it's not sorry, my apologies, it's not 14,300, it's 14. So, where have I got my 14,200 from? Well, I've got it from my equipment at cost, 14,200, minus the provision I was given, 9,210, which is simply going to be 4,990. That's the only non-current asset we have, so I might as well just underline it to emphasise that fact. So, we've got 3 current assets: trade receivables, inventory, specifically our closing inventory, and my prepayments. We would have had a bank figure in there, but we haven't because of our drawings. So our trade receivables are unaffected by our additional information. They're just 29,350. Our inventory, which we calculated earlier, was 4,600, and our prepayments are 2,450. Let me just explain that. That comes from 2,400 plus 50. Okay, so prepayments here were 50, but also we need to take into account the 2,400 that we didn't take account of. It says we treated it as an accrual earlier, so we need to make sure that we took that into account. So it's that figure plus the 50. So our current assets came to 77,400. Current liabilities was 4 trade payables, accruals, the bank overdraft, and 1/2 of the bank loan, which we calculated in workings free. So trade payables, they were unaffected, that's 14,780. Accruals were 400, that comes from 2,800 minus 2,400. I'll explain that just after I put the other figures in. We calculated that bank overdraft earlier, and we also calculated the bank loan earlier. That brings it to 21,290. So where did I get this £400 accruals figure from? Well, we originally had 2,800, but that doesn't account for the fact that we've accidentally treated a prepayment as an accrual. So our accruals are 2,400 less than what we thought, so just doing 2,800 minus 2,400 gives me 400. My non-current liability is only one, which is a bank loan, which is 3,000. I'm sorry I'm squeezing it on, but there's not enough lines for the whole balance sheet. And in total, I would write total assets here, net assets, but I don't really have the room, in all fairness. So I need my equity section here to equal 58,100. So my capital was 49,150. My profit from my income statement was 3,770, and my drawings, well, we originally had in our income statement 24,320. We need to take into account that 4,500 that we didn't account for in working free. So we need to add on 4,500. So that's going to bring my drawings to 28,820, and that is taken away from our equity, and that does come to 48,100. So these two figures balance. So we're all good. I hope it's a bit of a rush video, but I've only got a certain amount of room on the memory stick. So any questions to my email, it's in the description, and thanks for watching.